got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire.
Heard a lot about that concept of hoarding employees in this environment. That, of course, Fed Chair Jerome Powell after announcing a 50-point hike this week. While Powell singled out the tech industry as the one undergoing layoffs this year, news today that the banking sector might not be far behind. Semafor reporting that Goldman Sachs is preparing to lay off as many as 4,000 employees, around 8% of its workforce. Liz Hoffman broke that story. She joins us now. Liz, nice to see you. Why now is Goldman Sachs laying off 4,000 employees?
Goldman is a couple of years into this incredibly high-stakes transformation, trying to make itself less reliant on trading and investment banking and deal-making and into a little bit more of a stable, safer institution. It's not going that well. The short answer is that they massively overhired and overspent trying to build this consumer bank, this Main Street bank that they are largely now retreating from.
I got to ask you here what the fallout is here for the CEO, David DJ Solomon. What is it? DJ D-Sol? Is that his name? Okay, DJ D-Sol Solomon. All right, here's where I'm going with this. I remember Goldman Sachs back in the day. I'm going back to 2007-8. This was a company that was reportedly calculating their firm-wide risk to 3 decimal points. They were able to pivot on a dime under their previous CEO, Lloyd Blankfein. I'm just wondering, are there comparisons now, fair or otherwise, to D-Sol and the way he's running the business? Are there criticisms of what he's doing here?
I think the comparison is a little bit unfair. Wall Street was a very different place when Lloyd Blankfein was running it back in the day. David has clearly, I think, misjudged how hard it was going to be to build this consumer banking business and how long it would take for those investments to pay off. This is going to be Goldman's second best year by revenue. They're going to make somewhere $45 to $50 billion of revenue. And yet, there seemingly isn't enough to go around. And the short answer is that they spent it. And, it's easy to I think CEOs should be investing. They should be strategic and trying to look around the corner and figure out the next big thing. But at some point, an investment with nothing to show for it is just a loss. And they are eating those now, and it's cutting into their ability to pay people.
Very interesting to hear in your piece, you refer to Goldman Sachs as acting like a tech company. If you could give us a little bit more on that analogy, and what does the next iteration of Goldman begin to act like?
Yeah, the analogy is interesting, right? Because Goldman had never, after the crisis, its stock was trailing peers that were by all accounts like kind of less interesting and profitable, places like Bank of America and JP Morgan that have these big consumer businesses, but not these huge Wall Street profits. And the upshot was that shareholders didn't want that like risky investment bank anymore that was sometimes making a ton of money, but sometimes losing a ton of money. And it was very risky and hard to value and a headache to have in your portfolio. And so Goldman tried to become more like a universal bank. And the white space for them, they obviously have a large investment bank, best on the street, a very large asset management firm. And then white space was Main Street banking. And so they tried to fill out their portfolio and build that and become a little more balanced because shareholders wanted them to. So the comparison to tech is an interesting one because for a long time, venture capitalists, technology shareholders wanted their companies to grow. Don't worry about making money, just get bigger. And, the incentives were exactly the same. The path was a little bit different. But the truth is that there's a lot of pressure to go where your shareholders want you to go and where you're going to get rewarded for it in the stock price.
Well, Liz, let me ask you here, is Goldman thinking about getting out of the consumer business altogether? Because there are a couple different facets to that. It's not just loans, it's also deposits that would take on as liabilities from customers. And of course, that helps their balance sheet. To what degree are they thinking of just saying, all right, we tried it with the consumer and we don't necessarily want to do this anymore?
You have to remember where this started. Coming out of the financial crisis, Goldman's main problem was that its funding was bad. It was funding itself overnight and investing in long-term stuff, securities and real estate. And the best funding out there, no matter who you are, is consumer deposits. They're incredibly sticky. You can pay up a little bit to get them, and they were massively cheaper than the overnight securities-backed funding that Goldman had been relying on. So they went out in 2015 and they bought General Electric's old sort of online deposit-taking platform. And they started raking in deposits because they were paying pretty high interest rates at a time when, your checking account at Bank of America was yielding 2 basis points. But then the problem became, well, how do you wed those customers to the firm? Because if you're just out looking for the highest rate, you'll go to wherever the highest rate is. You don't really think of yourself as a customer of Goldman Sachs. So then they built this lending platform on the side of it that would do 2 things. It would try to make people feel like they actually were clients of the firm and would stick around. And then 2 was a place that you could deploy those deposits they were taking into these loans. And it'd be a nice income business. Investors would love it. And then they just got more ambitious from there, frankly. They got the Apple credit card, which again, by all counts, is a pretty good product. Will eventually start making money for Goldman. But again, most people who have that don't think they're customers of Goldman Sachs. They think they're customers of Apple because that's the logo on the front of the card. So they tried to, I think, really kind of duct tape together a bunch of products that might be considered like a primary banking suite. And they didn't really, and they are massively walking back from that. They'll keep the deposits. They will probably run the loan book off or lower over time. But then they carved out that what has started as that Apple Card business, and they now have the General Motors card and some other point of sale financing, which they're calling platform solutions, which is, the way to think about it is that they tried to go directly to the consumer to have a virtual branch. It didn't work. But the one thing Goldman really does have is incredibly good relationships with corporates. So they're going to sell those through their corporate clients.
Interesting. Liz, we haven't talked about Elon in like 15 or 20 minutes. So I got to bring it back up. Apparently a scoop from Semafor that you are quoted on. Elon's team looking for new investors and other news. What's the latest on the Twitter dumpster fire?
Yeah, so my colleague Reed Albergati and I just put out a story right before I hopped on the air that they're looking for new equity investors into Twitter, offering them the same terms that Elon bought the company on in October. So this would be, you can come in, we'll sell you equity at $54.20 a share. They're trying to close by the end of the year. Look, my read on this is that Twitter has a lot of debt, and it's very unclear that they're going to be able to make the payments. So they're trying to get more equity into it, which will lower the debt burden. Elon himself sold about $3.5 billion worth of Tesla stock this week. Presumably some of that will go to help stabilize Twitter. But this is a very precarious position for Twitter. They're in a ton of debt. Advertisers are fleeing the platform. They're starting to the product is starting to get a little problematic. This is a whole new chapter.
Whole new chapter, and really glad we could get that in there. So thank you for stopping by, Liz Hoffman.